Monday alert. Gold, silver, and Bitcoin just flashed a signal you can't ignore. Something just broke. Not a stock, not a company, not a single asset. Three of the most watched stores of value on the planet, gold, silver, and Bitcoin, just flashed the exact same signal at the exact same time. And if you know what that signal historically means, you should be paying very close attention right now. Because this isn't noise. This isn't a random Monday morning dip. This is a synchronized message from the market. And most retail investors are completely misreading it. Stay with me, because by the end of this video, you're going to understand exactly what just happened, why it happened, and what the smart money is already positioning for. Let me be direct with you. Gold peaked near $5,600 in January of this year. It has since fallen roughly 28%. Silver hit a historic high near $120. It has now corrected more than 50%. Bitcoin, which many believed had finally broken its speculative identity and joined the hard money camp, is down roughly 50% from its October peak. Three assets, three different markets, three different investor bases, one synchronized collapse. Now, the mainstream financial media is giving you one explanation. They're pointing at the Federal Reserve. They're pointing at the dollar. They're telling you the debasement trade is over. But here's what they're not telling you. The why behind this signal is actually more important than the signal itself. And the why points towards something far more significant happening beneath the surface of these markets. Let's go deeper. Act 1. The debasement trade and why it worked. To understand what just broke, you first need to understand what was working and why. From 2023 through most of 2025, a very specific macro thesis was driving capital into gold, silver, and Bitcoin simultaneously. The thesis was simple. Governments are spending money they don't have. Central banks are printing currency to cover the gap. And when a currency loses its purchasing power over time, the assets with fixed or scarce supply, gold, silver, Bitcoin, become the obvious alternative. This is called the debasement trade, and it ran hot. Gold climbed from around $2,000 all the way to $5,600. Silver, which always lags gold on the way up, then sprints to catch up, exploded from under $30 to nearly $120. And Bitcoin, which had lagged through most of the metals rally, was sitting near its all-time high with an entirely new argument being made about it, that it had finally earned its seat at the hard money table alongside gold. Three different assets, but the same underlying bet. The bet was, fiat currency is being debased, real assets win. That was the trade. And for almost 2 years, it was one of the best trades on the planet. So what changed? Act 2. The pivot that nobody saw coming. One man changed it. Kevin Warsh. If you're not familiar with that name, you need to be. Because right now, Kevin Warsh is the most powerful person in global financial markets. He is the chairman of the Federal Reserve. And his monetary philosophy is the direct opposite of everything that fueled the debasement trade. Warsh is a hawk, a genuine one. Where previous Fed leadership had become comfortable with elevated deficits, loose financial conditions, and the idea that inflation was a manageable side effect of growth, Warsh came in with a different mandate. Fight inflation, defend the dollar, let real yields rise. And that single philosophical shift has done more damage to gold, silver, and Bitcoin in the past several months than any geopolitical shock or economic crisis could have. Here's the mechanism. Pay attention, because this is the part most commentators skip. When the Federal Reserve signals it will keep rates elevated or push them higher, two things happen simultaneously. First, real yields rise. Real yields are what you earn on a bond after you account for inflation. When real yields are high, holding gold or silver or Bitcoin becomes expensive. Those assets pay no dividend. They pay no interest. So investors who can earn 4, 5, 6% in a US Treasury bond start asking themselves a very rational question. Why would I hold something that pays me nothing when the safest asset in the world is paying me handsomely? Second, the dollar strengthens. A hawkish Fed attracts global capital into dollar-denominated assets. That capital flow drives up the currency. And when the dollar rises, gold, silver, and Bitcoin, all priced in dollars, become more expensive for every buyer outside the United States. Demand softens, prices fall. This is not complicated, but it is being underreported. The debasement trade didn't die because governments stopped spending. It didn't die because inflation was solved. It died because one central banker decided to fight back, and the market believed him. Act 3. The signal nobody is talking about. But here's where this gets interesting, and I mean genuinely, uncomfortably interesting. What does it mean when gold, silver, and Bitcoin all fall together? On the surface, the answer seems obvious. Risk off, dollar on, yields up, debasement trade unwinding, end of story. But that surface-level explanation misses something critical. These three assets have very different buyers. Gold buyers are central banks, pension funds, sovereign wealth funds, institutional portfolios. These are not impulsive actors. They move slowly, they research deeply, and when they sell, they have a reason. Silver buyers are a mix. You have industrial manufacturers who need physical silver for solar panels, EV components, semiconductors, and AI infrastructure. You have retail investors treating it as a cheaper version of gold, and you have speculative traders riding the leveraged futures market on COMEX. Bitcoin buyers are a completely different universe. Crypto funds, retail speculators, institutional players via ETFs, and long-term hodlers who view it as digital scarcity. When all three of these completely different asset classes, with completely different buyers, completely different mechanics, and completely different supply chains, fall in the same direction at the same time, that is not a coincidence. That is a coordinated message from the market about the direction of one single variable, the dollar. The dollar is rising, and everything priced against it is falling. But the question you should be asking right now is not, why are they falling? The question is, how long can this last? Because history has a very clear answer to that question, and it's not what you expect. Act 4. What history actually shows. Let's go back to 2022. The Federal Reserve raised interest rates at the fastest pace in 40 years. The dollar surged, real yields spiked, and gold, silver, and Bitcoin all collapsed. Sound familiar? Gold fell roughly 20%, silver dropped over 30%, Bitcoin lost more than 70%. Every mainstream analyst at the time declared the debasement trade dead, and then something happened. Inflation didn't go away. Debt didn't go away. Government spending didn't slow down. The structural problems that drove the debasement trade in the first place, they didn't disappear just because the Fed raised rates. And by late 2023, the trade was back, stronger than before. Gold eventually went to $5,600. Silver hit $120. Bitcoin reached a new all-time high. The analysts who called the debasement trade dead in 2022 were spectacularly wrong. Not because they misread the Fed, they read the Fed correctly, but because they forgot the second half of the equation. You can raise rates all you want, but if the debt load becomes unsustainable at those rates, eventually something breaks. And when something breaks, the Fed pivots. And when the Fed pivots, the debasement trade comes roaring back. Right now, the United States is carrying over $36 trillion in federal debt. At current interest rates, the annual interest cost on that debt is approaching $1 trillion per year. $1 trillion per year, just in interest. That is not a sustainable fiscal position, and every serious economist knows it. So the question is not whether the Fed's hawkish stance puts pressure on gold, silver, and Bitcoin. It clearly does. The question is, how long before the math of the debt forces a policy reversal? If these conditions continue, historically, that reversal comes sooner than most people expect. Act 5. The silver case. Deeper than people realize. Now let me make a specific argument about silver, because I think silver is being misread more than any other asset in this environment. The mainstream narrative right now is simple. Silver is an industrial metal. When growth slows, industrial demand drops, and when industrial demand drops, silver falls. End of analysis. That analysis is dangerously incomplete. Here is the part that is being ignored. The Silver Institute projects that global silver demand will produce a physical market deficit for the 6th consecutive year in 2026. Even as total supply reaches a decade high of over 1 billion ounces, demand is outpacing it by roughly 67 million ounces. 67 million ounces. Not on paper, not in futures, in physical metal that the market needs and cannot find at current prices. Where is that demand coming from? Solar panels. Every solar panel manufactured today requires silver, and the world is building solar infrastructure at an unprecedented pace. AI data centers require enormous amounts of electricity, and a significant portion of that new power generation capacity is solar. Electric vehicles. Silver is used extensively in EV power management systems, charging infrastructure, and circuit boards. Semiconductors. The more sophisticated our electronics become, the more silver they require. This is not a trend that reverses, and yet, silver is down more than 50% from its January high. Think about that carefully. The fundamental physical demand story has not changed. The deficit has not closed. The industrial drivers are, if anything, accelerating. What has changed is the macro environment. Higher yields, stronger dollar, speculative positioning unwinding. Those are cyclical factors. The demand story is structural. When cyclical pressure meets structural deficit, the price doesn't stay suppressed forever. If these supply dynamics persist, and the evidence suggests they will, the math begins pointing toward a significant revaluation of silver. Not today, not necessarily next month, but the foundation is being laid right now at prices that feel like punishment but may one day look like opportunity. Act 6. The Bitcoin question. Now let's address Bitcoin, because Bitcoin in this environment is the most complicated of the three. Bitcoin lagged gold and silver during the 2025 rally. While gold was making new highs, Bitcoin was grinding sideways near $100,000. That divergence raised a very uncomfortable question. Had Bitcoin lost its identity as a hard money hedge? And then came the answer that nobody wanted. Bitcoin didn't just fail to rally with gold and silver on the way up, it fell with them on the way down. Hard. Bitcoin is now down roughly 50% from its October peak. It has broken below its 200-week moving average, a level that historically signals deep bear market territory. And the narrative has shifted. The mainstream view is now that Bitcoin is neither a safe haven nor a growth asset. It is an orphan, too risky for conservative portfolios, too correlated with falling crypto sentiment to attract new institutional buyers. But here's what I want you to sit with for a moment. Bitcoin's core thesis has not changed. 21 million coins, fixed supply. No central bank can print more. No government can inflate it away. The math of its scarcity is baked into the code. What has changed is the macro environment. Higher real yields make non-yielding assets less attractive. A stronger dollar compresses everything denominated against it. And the AI stock frenzy has pulled speculative capital away from crypto and into the Nasdaq. These are real headwinds. I am not dismissing them. But consider this. VanEck's head of multi-asset solutions has made the argument that Bitcoin is lagging the Nasdaq by roughly 50% since the start of this year. And that dislocation, that gap, is historically the setup for sharp recoveries, not permanent declines. The question is, what would trigger that recovery? The answer, almost certainly, is the same thing that triggered it in 2023 after the 2022 crash. A shift in Fed policy, or a crack in the financial system that forces that shift. Neither has happened yet. But the debt math we discussed earlier, it has not gone away. Act 7. The smart money framework. Let me give you the framework that institutional investors are using right now, because it is very different from the emotional reaction that most retail investors are having. Most retail investors right now are doing one of two things. They are either panicking, looking at 50% corrections and concluding that the bull market is over, that they missed it, that they should have sold at the top, or they are in denial, refusing to acknowledge the severity of the correction and averaging down too aggressively, too early, without a clear thesis for what reverses this trend. Neither of those responses is the smart money framework. The smart money framework starts with one question. What would have to be true for these assets to recover and exceed their previous highs? For gold, the Fed would need to signal a pivot, or a credit event, a sovereign debt crisis, a banking sector shock, a geopolitical escalation would need to force one. At that point, the rush back into gold would be rapid and powerful. For silver, the deficit story would need to remain intact, which it currently does, and macro headwinds would need to ease. When those two conditions align, silver's volatility works in your favor. The same leverage that accelerated its collapse will accelerate its recovery. For Bitcoin, liquidity would need to return to the system. When real yields fall and the dollar softens, the appetite for speculative and scarce assets returns. And Bitcoin, with its fixed supply and increasing institutional infrastructure through ETFs, is positioned to attract that capital faster than in any previous cycle. None of this is guaranteed. Markets can stay irrational for longer than any individual can stay solvent. Timing a reversal is nearly impossible, but identifying the conditions under which a reversal becomes likely, that is not impossible. And right now, those conditions are beginning to form at the edges. The debt math, the physical silver deficit, the historical pattern of Fed pivots, the structural demand for hard assets in a world of unlimited government spending. These are not small forces, they are structural, and structural forces over time tend to win. Act 8. The convergence. Here is the thing that keeps sophisticated macro analysts up at night. The scenario where gold, silver, and Bitcoin all broke down simultaneously. That is happening. But the scenario where they all recover simultaneously when the macro environment shifts, that is also a historical pattern. And when that recovery happens, it tends to be fast, violent, almost disorienting in how quickly prices move from punishment to reward. In 2020, when the Federal Reserve responded to the pandemic by cutting rates to zero and launching the largest quantitative easing program in history, gold, silver, and Bitcoin all surged within months. Silver nearly tripled from its March 2020 low by the end of that year. In 2023, when inflation began showing signs of peaking and markets started pricing in a Fed pivot, gold broke out to new all-time highs. Silver followed. Bitcoin more than doubled. The pattern is consistent. Macro suppression, followed by policy reversal, followed by explosive recovery in hard assets. We are currently in the suppression phase. The question, the only real question, is when the next chapter begins. And nobody can answer that with certainty. Not me. Not the most sophisticated hedge fund in the world. Not the Federal Reserve itself. But what you can do is understand where you are in the cycle. And right now, with gold down 28%, silver down 50%, and Bitcoin down 50% from their respective peaks, we are somewhere in the suppression phase of a very recognizable pattern. What comes after suppression, history is very clear about. Act 9. The risk you cannot ignore. I want to be honest with you about something. Because this channel is not in the business of telling you what you want to hear, there is a scenario where the debasement trade does not come back the way it did in 2023 or 2020. That scenario looks like this. Kevin Walsh maintains his hawkish stance for longer than the market expects. Real yields stay elevated. The dollar stays strong. The fiscal situation in the United States, while alarming in the long run, does not produce a crisis in the short run. And the demand for AI-related equities continues to pull capital away from hard assets. In that scenario, gold could find a floor, but remains range-bound for months. Silver's industrial narrative competes with its macro headwinds, producing a volatile but directionless trading range. And Bitcoin faces an extended bear market as liquidity remains constrained. This is not the base case of most hard asset bulls, but it is a real possibility. The mistake most investors make is treating their favorite thesis as inevitable. Nothing in financial markets is inevitable. Probabilities shift, conditions change. What separates the smart investor from the crowd is not the ability to predict the future. It is the ability to hold a clear thesis, define the conditions under which that thesis is right or wrong, and manage your risk accordingly. Know what you own. Know why you own it. Know what would change your mind. That discipline is worth more than any single trade call. So let me leave you with this. 3 of the most important hard assets in the world are flashing the same signal right now. They are telling you that the macro environment has turned against them, that a hawkish Fed, a rising dollar, and elevated real yields have created genuine headwinds. That is real. That is not something to dismiss. But they are also showing you something else if you're paying attention. They are showing you exactly what a structural entry looks like before a major cycle reversal. They are showing you the prices at which the fundamental thesis, scarce assets in a world of unlimited government debt, has been temporarily overwhelmed by cyclical pressure. The key word is temporarily. History does not guarantee the thesis is right this time, but it does show, clearly and repeatedly, that the structural argument for hard assets does not die when central banks get aggressive. It waits, and then it comes back, hard. The signal that gold, silver, and Bitcoin just flashed on Monday is not a death certificate for the debasement trade. It might be the last warning before the reset. The question is, when that reset comes, will you be positioned to benefit from it, or will you be the one selling at the bottom right before it happens? Think about that, and I'll see you in the next one.